Good afternoon. So this is the panel where we try to learn what we can learn from the wisdom of the equity analysts who are gathered here today. The five of you, Ben Nolan, Chris Robertson, Jorgen, Lian, we've all been introduced, Omar, Nokta, and Lian, Burke, represent roughly half of the total number of shipping equity analysts who remain on Earth.
I thought there were more. Wow. Okay.
Capital Link has a tagline, which is that your link with the global investment community. But for the past several years, that link has been broken for the shipping industry. And, unless we figure out how to persuade investors to pay more for shipping equities than the net liquidation value of the hard assets, none of you will be employed in your current capacities. So, I think the question for the day is, what do we do? Is the private market wrong? Are equity investors wrong? Ben, what do you think about that?
I think we're all going to be obsolete because of AI anyway, so it doesn't really matter. But I would say I've been doing this for a while. I'm not quite ready to throw in the towel just yet, but I do acknowledge that it's been a long, hard path from an equity standpoint. Capital markets have been pretty flighty, and relative to, I got in the business in 04, 05, and man, those were the glory days. There was a deal around every corner, and investors were calling, and it just hasn't been that way since. But as you say, here we are. So I think again, we'll get to the answers. I'm mostly stalling for time to hear what the smart people have to say.
Well, Omar, what do you think? Are the equity investors wrong? Is the private market wrong? What's going on?
No, it's a good question. I guess my fellow Aggie, Ben, was just talking about how it was exciting back in 04, 05. There were deals every couple of weeks. I think it just depends. I guess Hugh Crooks on a couple panels ago had mentioned that it's really hard for for Wall Street to value each company based off of the last done transaction, right? And so that's, I think, part of it. So when we're so fixated on looking at NAV, but there are other ways to value these companies.
Yeah, but they all come up with higher numbers.
I'll come back. I think.
Thanks, Ben.
Yeah, here to help you out. I think that, and this is what I've been saying for a while, there are a few things that you can extrapolate, help stocks to trade closer to their NAVs. One of those is average daily trading volume. One of them is size. But as you said earlier, that is not necessarily a hard and fast rule. There can be bigger companies with good average daily trading volume that still trade at discounts to NAV. Yeah. And so it's not a panacea. I do think, though, that what you have been able to, or what I've been able to find, is companies that are able to create a structure where there's a value-added service that transforms the way that people think about those companies from an asset base to a cash flow base, can sort of divorce themselves from this NAV conundrum. But that said, it is really hard for a just standard asset owner operator to reinvent themselves and create a sticky level of cash flow that isn't simply a function of owning X number of ships. So I think that's the answer, but it's not an easy path.
Well, so Chris Robertson, what do you think? What is the cause of this disconnect?
So at the end of the day, the market's a pretty efficient discounting mechanism. So I think the disconnect in my opinion, is that there's different risk profiles by ship owners themselves. Maybe have a bias towards positivity. Better days are always around the corner with rates and asset values, things like that. But I mean, if I'm an equity analyst or an investor in this space, and I try to do any traditional type of modeling, I mean, forget about discount cash flow models in this sector. I mean, what do you use for rate volatility and expectations and cyclicality? What do you use for reinvestment into the fleet in terms of the cadence? When does an owner-operator sell the vessel and have incoming cash? And then the whole question, what kind of discount rate would you even use, if you could even think about it that way, for a globally exposed shipping company, right? So I think complexity adds a layer of, a discount in the equities.
Mm-hmm. Liam, what do you think shipping companies need to do?
Well, you touched on it on the last panel, Hamish. If you outperform the market on your TCE revenue and drive your cash per vessel down below market, you're going to outperform your peers. Now, if you think of investors, I mean, they're not going to ask what your NAV is if your price performance, and we'll use the Russell 2000 as a benchmark, if your stock is outperforming the benchmark over whatever period of time you're discussing, I think the NAV becomes less of an issue, because part of your outperformance is going to be exactly what you said it was earlier, by generating higher than market value in the revenue side and below market costs.
Yeah. So Jorgen, you got some Norwegian companies, in your coverage universe.
A few.
And some of these actually trade remarkably well, given how, otherwise, puny they are.
Yeah.
Why is that? What do the Norwegians know that we don't?
Good question. I think, in my opinion, there's been a very different view of how to value this type of company between the two sort of pools of investors that we talk to here and there. You saw it immediately when the cash flows disappeared, for instance, in dry bulk for a while. People questioned the valuation among the US companies, I feel, more than they did on the NO-listed companies. And I do think part of the reason why we're seeing a lot of these companies now trading below NAV is partly explained by the one connection between all the different sectors. We're talking about shipping. Everything in shipping is tied back to what the yard cost of the vessel is to some extent. And right now we've had very varying results among the different shipping sectors in terms of earnings and cash flows, which have driven up that price in general on the new building side. And there's been a lot of discussion about this replacement thesis story when you talk about valuation. So it is a fair point that you're trading below NAV, but I think, as Omar said, that's based on the last done transaction, which I think the valuation reflects much of this replacement thesis. While the market overall, I think, has perhaps a longer horizon on things when they price in the valuations, and you compare that to the picture today, how NAV stands. So I don't necessarily agree, that the equity markets aren't there. If you look historically, for instance, dry bulk, the implied valuations in the listed companies, even though the discount to NAV is there, is still very high in a historical context if you go all the way back to the financial crisis.
Yeah, but I mean, it's pretty depressing that, you're actually trading below, calculated net liquidation value of assets when, you've got an actual management team who is hopefully not subtracting value. I don't know. Ben, what do you think about management subtracting value? Is that what's really happening?
I mean, unquestionably, that can be a problem, and I think that it can cast shadows on the whole industry, for sure. I think that the bigger issue here is that, as we talk, going back to the prior question about is the private market or the public market, right? Sitting in an equity seat, you tend to think that the equity markets are forward-looking, and so maybe more forward-looking than the physical market, and so they're anticipating a turn down in rates, and that would be fine, except the fact that they were backward-looking as asset prices were coming up. Stocks were generally trading well below NAV all the way up And so there just has never been a catch-up period in the same way there was in the last cycle. But yeah, so.
Well, I want to just continue
Yeah,
that.
sure.
I think kind of what Ben is, and I guess we've all talked about this, but I think ultimately there's two things that will drive the company's valuation, right? One is management, and is a company a good steward of capital, right? So that's one, that's the starting point. And then two, are you generating free cash flow? And as Ben hinted or talked about, what's the market starts to then perceive, okay, where's free cash flow going? Are we rising, are we falling? And I think probably the biggest thing that's missing this cycle, as opposed to the one from 20 years ago, is that there's no growth, right? It's not an exciting, sexy demand story. This is all about supply constraints, whether it's on what's on the water today because of all the disruption, or the fact that there's just not a lot of new buildings coming on. So that's,
I'm sorry, go ahead.
sorry, I was just going to say, so that's the biggest thing, where you get a multiple on growth. You don't really get a multiple on a value type of thing where we're at today.
Yeah.
But also different than the cycle has been the commitment of managements to allocate capital, returning cash to shareholders, reducing debt. All things being equal, if you look at the equation into an NAV, by paying down debt and reducing your share count, if asset values are the same, you're increasing NAV at the expense of your stock price. However, you're enhancing value on either side of it by returning cash to shareholders and paying down your debt. So you're essentially penalizing yourself while rewarding your shareholders.
I guess if I can chip in, because I guess what is really what is the reason to value something on liquidation value when nothing is liquidated? I guess that's what a lot of the shareholders are asking, right? Which I guess you could do something about by having a commitment to actually liquidate the entire business if that's what needed in order to get that value out of the company. And I think you mentioned one of your peers, a no-listed company, which might be puny, but valuation looks to be very good and is driven by a management that has a very clear mandate to liquidate that company if there is a large disconnect. So if you want to get liquidation value as a pricing point to your equity, you need to be willing to put down the business in order to make that happen, or else it's not really relevant, I would argue.
Which company is that?
Well, there's the 2020 bulkers have done an amazing job on valuation, right?
Yeah. Now, I mean, I guess let me ask Chris Robertson, I mean, let's say you have a company that, has lower costs and higher revenues because it employs all the people who run the ships. Now, I guess if you're committing to liquidate the company, if you have to support the share price, that's probably a company that doesn't have a lot of employees. But if you develop this big infrastructure to reduce costs, to increase revenues, in theory, I would have thought you're going to increase the value. But the market doesn't seem to pay. So, Chris, what do you think of this?
Well, we keep coming back to this point around liquidation value and what is NAV today, but I mean, let's be real that it's a moving target, right? So we keep going back to the last deal done price, there's an asymmetry in the market between the data that owners have and brokers provide versus what the average investor has access to. I mean, there's a few providers out there, but not very many, right? So, I mean, this is a moving target, and I think it's a bit unrealistic to say if the company was liquidated today, which, there's stickiness to that when you're talking about large fleets and the time it takes to secure a deal and all these other things. So it's a theoretical number on its face of what could it be liquidated at today. It's kind of nonsensical in a real world, right? And then, let alone looking back, this is a last deal done price if you're using shipbroker information, or it's a little bit of a black box if you're using something like vessels value or something like that. But these rates and these underlying asset values are always changing. So I put it back on you, Hamish. Would you rather your stock price in 5 years from now be trading in line with NAV, or would you rather your stock price be trading up? The two aren't mutually exclusive, but let's focus on what matters here.
Yeah, no, I mean, indeed. But of course, if you're issuing shares to buy ships, it's pretty embarrassing if you're, not able to buy a ship if you got 2 ships and you have to sell more than half the company to buy a 3rd ship, that's pretty embarrassing.
Yeah, I get that, right? I see, but going back to the panel that we had on the dry bulk panel, right? If you ask the people about where valuations are seemingly today, I would say there's a bias towards rather selling than buying, perhaps at today's values, right? And the market is essentially pricing the same thing. And I would say it's a shame that, the equity investors don't necessarily appreciate, for instance, in Star Bulk, right, where the cost base is incredible and the operations are, magnificent. But the point is you're appealing to an investor that has a long-term perspective. So looking at the short-term valuation metric, which is NAV today, I'd say that makes it less relevant, right? That's what people are buying into. It's the longer-term story. If you buy into the organization, it's not the liquidation value. Mm-hmm. That's why liquidation value doesn't really give you the pricing today, I would argue.
Mm-hmm. Hamish, I want to add one thing about the source of capital when buying a new vessel. The companies we follow, or I follow, that have added vessels or are in the process of adding vessels are not issuing new stock. Mm-hmm. They're taking the cash that they've generated from their existing fleet, being able to raise debt and actually add vessels that way to be able to enhance the earnings power of their fleet. But it's not as a matter of fact, they're doing this while still buying back shares and paying a dividend. Mm-hmm.
Now, do you think, Liam, that it is appreciated by investors when a company that is trading below apparent liquidation value is using its hard-earned money to buy vessels at full net asset value as opposed to, buying back shares?
Investors on balance would prefer buyback of shares. However, if you want to either reduce the age of your fleet or you want to add vessels at the right price to enhance your cash flows, to be able to create this process, I don't think investors are going to sit there and say, okay, what was the NAV of that vessel you bought and what is your NAV? It's what is the cash you're generating and what are you doing with that cash?
Yeah, I agree. I would say it's, you're going to have a few loud people who say, you should have bought back stock with all that cash. But at the end of the day, it just comes down to, is the deal accretive or not?
Yeah. And so, Omar, which companies are trading well and, what can we learn from those companies?
Well, the trading.
Are there any companies?
In your definition, trading well is above NAV.
Well, I mean, that's like the minimum, right?
Because you have trading well, you have liquidity.
I mean,
NAV.
Trading above NAV is like saying, you've got COVID, but you're still alive.
So I guess you'd look at the one sector that's been consistently strong, where there's been the most, investor interest, and that's been tankers, right? And so you can look at the group and say, okay, it's really just Frontline that trades above NAV, and that's just a long-term track record. We all know that. But then if you look at everybody else, you have, DHT, Torm, Hafnia, they're generally in that 90, 95%. You could say that that's NAV.
It's pretty depressing, though. I mean, like, if for it to be not clearly different than NAV, right? I mean, it's saying that management is doing on a net basis nothing relative to having a ship at auction.
No, I don't think management is the problem. In certain cases, clearly, there are those who have destroyed capital, and you get a zombie valuation. Mm-hmm. But I think on the whole, I don't think investors are penalizing the companies for management. It's just they're not willing to pay what the private market's willing to pay on one ship at a time.
Let me add to that, Hamish. I think it's dangerous, let's say, to cross-compare different sub-verticals in shipping. So I know we think of it as a big lump, just shipping companies in general. But to Omar's point, I mean, if you see where the cluster is of companies that trade closer or in line with their premium to NAVs, they seem to be clustered around crude tankers. So as a dry bulk owner, I wouldn't suggest comparing yourself on this kind of multivariate analysis to a crude tanker company. Look at your peer group and assess kind of what's being discounted in certain prices there. Is there management issues in one stock that's reflected in lower than compared to the peer group, let's say? So I think that's a more fair apples-to-apples comparison. But, I mean, with crude, I think Omar raised this point a few years ago, if I'm not mistaken. But in the mind of an investor, there's a few themes that the crude market offers, right? So you can talk about OPEC increasing supply, increased demand, looking at IEA forecasts or global oil forecasts, et cetera. It's a relatively simple market to understand, let's say, compared to a segment with exposure across multiple industries and commodities. So if it's dry bulk, for example, then I have to become semi-knowledgeable in the iron ore market, in the Chinese economy, in the bauxite trade, in the Brazilian miners, et cetera, et cetera, et cetera. So again, I go back to the point of the more complexity you add into a model or the way you think about valuing a stock, the more likely, in my opinion, that the discount will be higher.
Mm-hmm.
And I think that I think it's a good point. And as you said, Omar, I think the previous upcycle 20 years ago, you had this general perception, I think, among everyone that there was a lot of demand to come. So that was not really the discussion point. Right now, I feel we're much more in balance, right, which puts that long-term money a bit more at risk. You don't necessarily want to fund a ruining of the supply story that got you there in the first place, mm-hmm. right? Whilst previously there was a lot of money available exactly to adapt to a new environment with lots of demand coming on stream. And that's a bit more difficult to pin down right now, I would argue.
Sure. Nicholas Bornozis is asking a question.
It's only his conference.
So Mr. Bornozis asks, investors pay based on yield and growth generally, and why can't we apply this to the shipping industry, which, at least has yield? And we could grow if the shipping shares were priced high enough to actually issue. Who wants to?
Well, let me go. I'll say the shipping industry is not NVIDIA, right? Like this is, you could argue there's maybe little pockets of growth where the market can be forward-looking, but otherwise it's cyclical, and that means that you trade it, you don't own it. This is a date not marry business, period, unless you are an asset owner or this is a family business and you don't really have a choice. From my point of view, again, if you go back a few years ago when the order books were really small and it looked like there might have been a good opportunity and the asset prices were low, well, that is an opportunity to grow, but it's a temporary opportunity for growth. You have to be nimble. This is not for long-term capital, period. Like, I know that everybody wants to sort of go appeal to the long-term investors. If they are, they're misallocating their time.
Nicholas, there's also another variable in here. What kind of return can you generate on these assets? And investors do pay attention to that. Mm-hmm. And in the past, if you wanted to lever up and buy more vessels in a very cyclical, seasonal environment, you were going to get hurt.
Yeah.
Managements are looking at it differently now. They're managing for the down cycle rather than the up cycle, and returns are really strong. If you look at the tankers in my space, they're generating ROEs in the mid to high 20s. Mm. And that's the function of pulling capital out of the business and allowing less volatility. As Ben points out, this is a wildly cyclical sector, but reducing volatility as well. So it's a little more nuanced than just saying a 5% yield and I want a 10% growth.
So Omar, let me ask you, there are various things that I've heard investors asking shipping companies to do. They want to renew the fleet, but they want to sell vessels at a good price. They want dividends, but they also want share buybacks. They want big market caps and high liquidities. All of these things are in tension with each other. Fleet renewal and selling vessels, is like not quite the same thing. Dividends oppose share buybacks, but so do large market caps and liquidity. What should a shipping company do?
Well, I think we were just mentioning, it's basically, you're in a cyclical business, right? So all of these factors are going to, throughout the cycle, each one of those is going to carry like a significant amount of importance. But ultimately, investors want to invest in a company because they believe the stock is going to go up. And so what's going to drive it higher are the fundamentals. You can do all the tactical things, dividend here, buyback there, but ultimately the stock price is dictated by the fundamentals that are driving the company.
So, Jorgen, why do people pay more than NAV when the NAV is going up or high, and pay less than NAV when the NAV is low? Which you would think it would be the opposite.
Yeah, I would argue it is, but so I'm not necessarily sure if that's true. I think in a declining value environment, people tend to price in a negative or a discount to NAV, whilst it's the other way around. 2016 in dry bulk was a very good example where you started to see considerable pricing above NAV because of the anticipation of increased valuations.
Well, I mean,
right?
that was also because NAV was 0 or negative.
Yeah, well, that helps.
Maybe
You know,
negative.
timing the bottom, it doesn't get much easier than 0. So.
Yeah, Chris, what do you think? What about what do you do about all these goals that are in tension with each other?
Yeah, it's a good point, Hamish. I mean, this goes back to what Ben was saying about where is your investor focus. I mean, we like to think of the investor as this amorphous blob of one person with a single different strategy, but it's not like that. I mean, I deal with different types of clients all the time, whether they're focused on what's yield going to be this quarter, or what's a trough to peak valuation of one company, what's free cash flow yield. So I want to go back to Nicholas's question for a moment too. I mean, owners talk a lot about price to NAV ratio, but my clients aren't necessarily just focused on that type of ratio. I get a lot of questions coming in about, you know, free cash to equity yield, dividend yield, et cetera. And it's about what you're doing with your cash to maximize returns in the good times while preserving capital in the bad times and deploying it opportunistically. And so, you know, don't underestimate the investor and their complexity in this space. They're not all created equal. So I would say, you know, to balance these things, I think a good owner and steward of capital is going to balance what types of investors they would like to attract.
Mm-hmm. And Liam, a question for you. What would you say if you had a child who wanted to go into the shipping industry? What advice would you give that child?
I'd introduce them to some of the management teams and just say, why don't you go walk around the office and find out what these guys do during the day? And then, sort of like shadowing at a school. And then I'd pick certain ones and see where that goes. But it's an interesting space. Now, whether or not that's a compliment or an insult, I'm not sure. But I think the way, I mean, I'm relatively new. All these guys were here since 2008. I came 10 years later. And it has made a dramatic change for the better. And you're still going to have to move stuff from here to there. And it turns out that, you know, people working on moving it better.
So, Omar, why do people hate this industry?
Hate. I love it. Yeah.
I love it as well.
Define people.
Well, we love it, right? But there are people who invest money who sell these shares when they get to like 80% of liquidation value, right? Why do people hate it?
It went through a very long downturn, right? From 2009 to 2019, right? And then we're about to, you know, break into 2020, and then COVID happens. But, you know, I think you had a lot of capital that, like, if you remember, obviously 2011, 12, all that private equity capital, all the hedge funds that raised capital to take advantage of a down market, and they all imploded. And so you still, that's still in the background, but I think we just need a bit of a track record. Right, I don't think any companies need to do anything brash or significant. Just stay the course, continue to operate. You're in a great position, whether you're Star Bulk, even though dry bulk right now is this kind of meandering, not exciting, it's not bad, but your balance sheet's in great order. And so you just stick with it. Don't do anything aggressive. Tanker companies, same thing. You don't know what the future holds. And as long as you stick with that strategy, you're going to build a track record that eventually the investors are going to come in and start to place a more significant valuation on it.
Hamish, I have an audience participation kind of activity for a minute. If you've been a shipping investor or analyst in the equity space and shipping, raise your hand. So, no, keep your hands up. Lower your hand if you've been in this for over 10 years.
None left, no.
Over 5 years. And if you've been following the industry for less than 2 years, raise your hand. So, a few, right?
So people love it.
No, the point being is that, you know, there's long memory.
That's good.
in the equity market, and to Omar's point of looking at the last cycle. And I think a new generation of portfolio managers, a new generation of buy-side analysts, relationships that analysts such as ourselves develop, that can reinvigorate interest. But it's hard when the people that were there during the last very bad down cycle either got burned or they have memory of it, and they don't want to touch the space. So I think time heals some of that.
I don't think so. And I'll tell you why I hear from people that are like, I just am not going to touch it. Like, I'll talk about your other stuff, but I don't want to hear you talk about shipping. And generally, it goes back to sort of what Omar said about people having been burned. But the reason is that there's a view that the only market that is more fragmented than shipping is babysitting. And that there is just absolutely, this is going to be tip of the whip, extreme volatility. Nobody has any true pricing power. And you're never going to be the smartest person in the room. And there are a few people who think they're really smart, and they work at hedge funds, and they do traffic in this, and they have their own little hedge fund mafia. But the whole rest of the world has gone through a multi-decade cycle where they've just figured out the only thing that happens when I buy these is they go down, and I'm done, right? And I don't see that changing anytime soon. Other than, again, it's cyclical, and there'll be times when people are like, okay, fine, I feel it's de-risked, but I'm going to keep an itchy trigger finger here.
So why do you stick around?
Hamish, I have 5 kids and a mortgage, so I'll do whatever you want me to do.
And Jorgen, why do Norwegians only invest in Norwegian companies?
I think that's. I don't necessarily think that's the case, really. But of course, it helps. You have slight home bias when you have easy access to management and whoever. It's a small community, to be honest, and of course that helps a bit. But in terms of, if I can go back to the everyone hating on shipping argument, I mean, focus is a lot on the average discount to NAV and values, right? But I think what's more interesting, and I think you touched on it, Chris, is you shouldn't necessarily gauge yourself against the other subsectors in shipping. I think it's important to have a relative advantage on pricing. And as long as you have that, there's lots of opportunity also by being a public company, right? So that equity can then be used as currency to do interesting things. Maybe not build a massive new building program and overbuild the fleet, which I guess is a good thing for the longevity of this. But anyway, that should be the focus rather than the absolute measure of value, which again, I believe is much tied to the new building prices these days.
Well, let me ask Omar, how do you think shareholders would react if, a shipping company ignored, relative value and just said, long-term issuing equity today to buy ships is, it's what I want to do?
If the transaction made sense. Right?
Well, does it? I mean, I guess that's the question.
Investors will price the stock. They'll price the follow-on based
and they'll price it really low, I guess.
Well, it depends on what you're buying, right? And it depends on ultimately what the earnings are going to look like as a result of it.
Well, but if the stock is priced at a 20% discount to net asset value, and you issue it to buy ships that you think will be really good, I mean, is there any way to sell that?
If you can make the compelling case that you're going to earn more per share.
Yeah.
But it's hard to do that unless you have cash flow visibility. Like, right. Fine, if you're buying something that has a 10-year contract, great. Otherwise, it's just a bet. It's a gamble.
So reduce the debt, the bet part of it.
Mm-hmm.
Yeah. But if it's a compelling deal.
Well, in tramp shipping, tankers, dry bulk, I guess the container lines, I think net asset value is almost impossible to define. But container ship owners, have a net asset value that is hard to define, but still possible. What examples of tramp shipping companies are, trading, what do you need to do? What's the secret? We have 40 seconds.
I'd say consistency. Consistency over time, I think, is the way to go, to be honest.
Yeah, I agree.
And issuing equity at 20% discount would set a ceiling to that share price. So if you want to trade at 1 times NAV, I would recommend probably not.
Actually, wanting to trade at 1 times NAV is really depressing.
Well, the other thing, Hamish, just to knock it out with 20 seconds,
Yes.
I mean, more of the same, rather than issuing shares and buying assets, liquidating the capital structure by using your existing fleet and selectively adding vessels if the return is right, but becoming more return-driven, which the sector is moving towards. And I think that'll help. But you have to convince investors and you have to create that track record, which I think they're well on their way to doing.
Well, I guess we're out of time. Does anybody in the audience have any really penetrating questions? So Mr. Bornozis asks the question, shipping is, the analysts have said that shipping is very cyclical. Would having investments in multiple sectors in one public company help to relieve that cyclicality and be more favored by investors, as it is by many private ship owners?
Okay. I think, having done this for years, have always been sort of a proponent for pure plays just because investors can buy exactly what they want. But and to your point, there have been a few companies that are trying to diversify and not buy at the top and allocate across sectors. And I think the answer to that is to be determined. A few years ago, I would have said bad idea. Now, maybe. You might not. Maybe that's a way to divorce yourself from NAV. Maybe.
Chris?
Yeah, I would say that, a conglomerate type of discount is seemingly present, but I agree with Ben that it's yet to be seen. But even in subsectors, we talked about containers, for example, where there's, cash flow coverage with long-term charters, et cetera. It's not even there where there's visibility on cash flow and locked-in charters, et cetera. It's not been quite enough, let's say, on the owner's side to get above NAV either, so I'm not sure.
Jorgen?
Generally, I would say increasing complexity tends to be a bad idea, which is why I'm a proponent for the pure play type shipping.
Omar?
I think it's probably the best way to go, is to be diversified. Not a conglomerate, but diversified.
What's the difference?
A conglomerate would be a collection of different businesses
Okay.
that are not related, perhaps. And then, diversified is, probably the best way. But I think, as Ben mentioned, it's going to take time. You have to basically show the benefits of being that way in a good market, and then how you manage through a bad market.
Liam?
Generally, I think investors would not like the idea. Adding complexity, as pointed out earlier in the panel, is a big deal. Management's ability to manage multiple sectors, how you're going to do it. It would take a while to educate the investment community that's more used to pure plays. I understand there are others out there like the SFLs of the world, but in a spot environment, I think it would not be well received initially.
Any other questions from the audience? Okay, yeah. How would a rapid U.S. dollar depreciation change capital allocation strategies in shipping? Anybody have a reaction?
Presumably, it would melt up everything.
Sorry?
Presumably, everything melts up, and that's
It
it.
melts up.
Yeah. Then you've got an emerging market story again.
You wouldn't see a lot of vessel purchases. Obviously, the return profile of an asset purchase on a lower dollar value would make it tougher to add assets.
Well, thank you very much.
I would like to ask you to give a round of applause to the panelists and above all to Hamish, who really put together a tremendous set of questions. Hamish, thank you. That was an amazing panel. Thank you, guys. Thank you very, very much.